In February 2022, Meta lost over $200 billion in market value in a single day, the largest single-day collapse ever recorded. The drop followed an earnings release that revealed something markets had not priced in. Growth had started to break. For the first time in its history, Facebook reported a decline in daily active users, signaling the platform had reached its limit. User growth had always powered the system, so even a small decline changed how the entire business was valued. At the same time, Apple's privacy changes cut off Meta's ability to track user behavior across apps, reducing ad precision overnight. The company estimated a $10 billion revenue impact, exposing how dependent its model was on data it no longer controlled. User attention began shifting toward short-form video platforms, pulling engagement away from Meta's core products. Meta was now facing weaker growth, reduced targeting power, and rising competition at the same time. What looked like a single earnings miss quickly revealed a system that was already under pressure and starting to give way. On February 2, 2022, Meta released earnings that immediately shifted how the market viewed its future. Revenue reached $33.67 billion, but the forward guidance pointed to a slowdown that investors had not expected. Then came the detail that changed everything. Facebook's daily active users fell from 1.93 billion to 1.929 billion. The drop was small in absolute terms, but it signaled that growth at scale had stopped. For a business built on continuous expansion, that signal forced a complete reassessment of long-term potential. Within hours, Meta's stock fell by approximately 26%, wiping out more than $200 billion in value. The speed of the reaction showed that the market was not adjusting gradually, it was repricing the entire system at once. Investors began shifting their view from high-growth platform to maturing business under pressure. What appeared to be a single earnings update had exposed a structural turning point that could not be reversed quickly. For years, Meta operated a growth system that scaled with unusual efficiency, converting user attention into advertising revenue at global scale. By 2021, that system was generating over $117 billion annually, with margins that few companies could match. Each additional user strengthened the model, adding more data, improving targeting, and increasing advertiser returns. That loop allowed revenue to grow faster than user numbers, creating a powerful compounding effect. Instagram extended this advantage into mobile, capturing engagement where user behavior was shifting. Advertisers depended on Meta's precision, often allocating budgets based on predictable performance outcomes. Valuation followed the same logic, assuming the system could continue expanding without meaningful friction. However, that assumption depended on two conditions holding: continued user growth and unrestricted access to data. Once those conditions began to weaken, the strength of the system turned into a point of vulnerability. By 2021, Meta's growth engine began slowing in the markets that had driven its scale for over a decade. In North America and Europe, user growth had plateaued, leaving little room for meaningful expansion. At the same time, younger users were shifting toward short-form video platforms, reducing time spent on Meta's apps. Less engagement meant fewer high-value ad impressions, directly impacting revenue potential. Then came a structural shock. Apple's App Tracking Transparency update restricted cross-app data collection. This change limited Meta's ability to measure and target ads, weakening the precision that advertisers relied on. The company estimated the impact at around $10 billion in lost revenue for 2022. Advertisers began seeing lower returns, forcing Meta to adjust pricing and delivery models under pressure. Growth had not just slowed, it had lost the conditions that made it reliable in the first place. As pressure built on the core ad business, Meta moved quickly to shift user attention toward short-form video through Reels. Adoption grew rapidly, but monetization lagged behind the traditional feed, where ads had been more profitable. More time was now being spent on a format that generated less revenue per user. At the same time, competition for attention intensified, forcing Meta to prioritize engagement over efficiency. The company increased spending on infrastructure and AI systems to support this transition. Costs rose faster than revenue, narrowing margins that had previously remained consistently high. Investors began noticing that growth was slowing while expenses continued to climb. The business was now generating less value from each user while becoming more expensive to operate. This combination created sustained pressure, pushing the system toward a critical strategic decision. As the core business weakened, Meta committed heavily to building the metaverse through its Reality Labs division. Spending exceeded $10 billion per year, despite the project generating minimal revenue in the near term. In 2022 alone, Reality Labs reported operating losses of over $13 billion. Capital was now being directed toward a long-term vision, while the core system was under immediate pressure. Investors began questioning whether resources were being allocated away from stabilizing the existing business. Confidence weakened as earnings reflected rising costs alongside slowing revenue growth. The gap between investment and return continued to widen, increasing uncertainty around future profitability. Meta's valuation declined further as the market reassessed both its growth and capital strategy. What had been a growth-driven company was now facing pressure from both declining efficiency and aggressive spending. After the February 2022 earnings release, Meta's stock fell by approximately 26% in a single session, erasing over $200 billion in value. The decline did not stop there, with the stock dropping nearly 70% from its 2021 peak by late 2022. Revenue growth slowed to single digits, while operating margins compressed from around 40% to the mid-20% range. The business was now earning less from each unit of attention while carrying a higher cost structure. Meta announced layoffs affecting more than 11,000 employees as part of a broader cost reduction plan. The company shifted from expansion mode to efficiency mode, focusing on stabilizing operations. Capital spending was adjusted, but losses from Reality Labs continued to weigh on overall performance. Investors began evaluating Meta not for growth potential, but for its ability to control costs and maintain profitability. What had once been a high-growth system was now operating under constraints that required structural change. In 2023, Meta began restructuring around efficiency, cutting costs while rebuilding its advertising systems. The company introduced AI-driven targeting models to recover performance without relying on third-party tracking. Ad efficiency improved, helping stabilize revenue despite the earlier disruption. At the same time, spending discipline increased, with a stronger focus on returns rather than expansion. Reality Labs' investment continued, but with greater scrutiny as losses remained significant. The business recovered part of its market value, but the growth model no longer operated under previous assumptions. Growth users remained limited in mature markets, reinforcing the reality of saturation. Advertising performance now depended on internal data and AI systems rather than unrestricted tracking. Meta emerged more efficient, but fundamentally changed, showing how quickly a dominant system can come under pressure when its core assumptions break.